and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy. I am your host. And before we get into anything else, let me go ahead and thank our sponsors. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios, previously only available to big institutions and the ultra-rich. Check out their website at simplify.us. At simplify.us, you can find their entire lineup of ETFs at simplify.us/ETFs. And I wanted to do that first because I have to start this podcast with a mea culpa and an apology because it's been a long time since I posted a podcast, and I didn't want to do that and then go into the sponsor spot. But this is the monthly CPI report, and that's going to happen. That podcast is going to happen no matter what. There's a calendar for it. Whenever there's a CPI report, then I have to do this, and I'll continue to do this. But the last month or so has been really busy with lots of things related to the launch of the USDI coin, the cryptocurrency that's linked directly to CPI, and that accretes directly with CPI continuously. And that's a new venture for us. We launched it in April, and it's occupied a lot of our time trying to get market makers and get the thing off the ground. So I apologize. That's not a very good excuse. That explanation is not a very good excuse because it only takes a couple hours to go and put together, a podcast, and especially with the low quality editing that you have become accustomed to because I do the editing. And so it's really not a great excuse that I've been busy on other things. So I'll try to do better. Sometimes it's just that topics come up and they're not quite timely enough or they've passed their time. And so I'll have a list of topics and if I don't get to them, then they become stale. So one of the topics that I had wanted to talk about a few months ago was what happens if Doge audits Fort Knox and there's no gold there. And I never got around to doing that podcast, and it's a good thing because as far as I could tell, Doge hasn't audited Fort Knox, and there's no plan to do it. It was a very exciting story for a very brief period of time, and it turned out to be totally irrelevant. So that happens sometimes. I have an idea for a podcast, and then it just never comes to fruition. And if I get unlucky enough weeks in a row, then I end up having no podcast for a week or two. So, but anyway, I apologize. You benefit from regularity. I benefit from regularity, but we're also getting into the summer doldrums and Memorial Day and all those things. And so I know that the desire of people to sit around and listen to a markets related story, an economy related story is just not necessarily really that high, at least judging from the activity in the markets, which has been, at least in the markets that I mainly focus on, the inflation-linked bond and, inflation-related markets, those have been dull. Not much has been happening. Break-evens go up a little bit. They go down a little bit. Real yields go up a little bit. They go down a little bit, but it hasn't been a particularly exciting month. And I hope that's not the standard for the whole summer. I hope it gets a little bit more interesting as the summer goes along, but it does seem like every year the doldrums stretch longer and longer, and I don't really know why that is. But let's get into today's number. It was a weird one, and it's a little bit to sort out. But let's set the expectation going in. The consensus was for 0.17% on the headline and 0.28% on the core, which I kind of felt going in was potentially a little low because we've had a couple one-offs pulling things down, and I didn't think it was necessarily very low, but I thought there was a chance we would get an upside surprise, and I was very, very wrong on that. But sort of the underlying context for this report and really the next couple of reports and the last couple of reports is tariffs and what's going on with tariffs and when will we start to see the effect of the tariffs. Now that story isn't isn't over yet by any stretch of the imagination because, there was Liberation Day at the beginning of April when a bunch of tariffs went into effect and then a bunch of them were delayed. But there was also the Canada and Mexico tariffs before that and the China tariffs before that. So there's been a lot going on in the early part of the year and things that were delayed and postponed. And part of the reason they were postponed was that, especially on China, isn't because there's negotiations going on, but it's really because this is the Christmas ordering season already. And so the smart political decision was to, let's not see if we can jack up the price of Christmas for everybody. Let's wait till we get past that season and then we could jack up the prices. And that will bother people less. And so, but that's not how it was couched, of course, the pause. But anyway, the point is that with all those things going on, things going up, things going down, there's a lot of uncertainty. There's a lot of uncertainty if you're a manufacturer or a retailer. And so, one of the responses of a manufacturer or a retailer to lots of uncertainty about pricing is to not change prices unless you're pretty sure that there's kind of like a permanent loss there. And actually, this sort of changed a little bit during COVID. Prior to COVID, a typical pricing response of a manufacturer to changes in input costs was that they would absorb increases in costs that tended to be temporary. And so, as supply chain costs went up and down, the manufacturer would simply absorb that and not pass it through. And so prices were much stabler at the retail level or the intermediate level than they were at the primary level. That changes once a manufacturer perceives that there's a permanent level of inflation and there's a permanent change in the price level happening. Then what happens is that manufacturers tend to pass on as quickly as possible those pass-through. They want to pass through those costs as quickly as possible because they're perceived to be permanent. If we know every month inflation's, the price level is going to go up 1%, and then when the price level goes up 1%, we don't try to absorb it knowing that it'll go back down later because we know there's this upward trend. And so manufacturers pass through prices, retailers pass through prices differently in an inflationary environment than in a stable pricing environment. And post-COVID, there was a lot of evidence that was happening and that was adding momentum to inflation. Now that inflation has come back down to still too fast, but a moderate level, maybe that's not happening as much. And that's kind of perhaps what we're seeing in these first couple of months where we haven't yet seen any evidence that tariffs are being passed through. Now, that could simply be that the demand elasticity is much higher than a lot of people had thought. It may be that tariffs are being passed through. Well, it is the case that tariffs are being passed through in some goods, but those have a low enough weight that it affects just that particular category, and it just doesn't have much of an effect on the overall number. And in fact, even if the full tariffs went into effect, because goods are less of the basket than they used to be, and less than half of the basket, even a significant change in those goods that are imported. So that's a fraction of the goods, and the goods are a fraction of our total basket. Even an important change on those imported goods wouldn't have an enormous change in the overall price level. Measurable, significant, but on the order of maybe 0.5%, 0.75%, one-time effect over the course of a year. So the effect is never going to be enormous, but it should be visible, and at least so far, it hasn't really been visible. Oh, and by the way, it's not just tariffs, so that's pushing things higher. We also have, Trump's announcement of the most favored nation policy on pharmaceuticals, which is expected to push drug prices downward. I don't think it's going to be a major push downward, but it's going to be in a downward direction. So we have all these things kind of going on, and then we also have the deportation of illegal aliens and the self-deportation of illegal aliens And that's going to put downward pressure on rent inflation. But how much depends on how big the deportations are. And it looks like it's not going to be millions. It's going to be tens or hundreds of thousands, optimistically. And so maybe that effect isn't going to be very large. But so these are all things that we're looking at. And in the meantime, the Fed is keeping rates, slightly above neutral, but money supply growth has accelerated to a level that's probably not consistent with price stability in the long run, given that we now have demographic headwinds and deglobalization headwinds. But anyway, so going into the figure, let's get to the figures. So the expectations, as I said, were for 0.17 on the headline, 0.28 on core. We actually got 0.08 on the headline, so missed by a full tenth almost, and 0.13% on core, so missed by 0.15% on core. That's a massive miss, right? And in the good direction. And most of the misses recently on core have been to the downside. Most of them have been kind of small. This was a significant miss. And again, it's a miss in a direction that you wouldn't expect if you thought, gee, we're going to see the effect of core anytime, the effect of tariffs on core anytime soon. So now median, as usual, we're waiting for the median to be officially calculated, but it's going to be something like a quarter, which will be the lowest since last July. Still not showing as big an impact as big a miss as on core, but that's kind of the nature of median. But anyway, let's the meat of the issue here this month was that there were a couple of large categories that were significant drags. And some of them are the usual suspects, but not usual in this case. So, for example, used cars, new cars. Okay, used cars, we know, highly volatile. It was a surprise last month. Used cars declined and people weren't really looking for a decline. And guess what? They declined again. And that's the used car CPI for used cars and trucks was down 0.54% month on month. It was similar last month. And new cars, which had been roughly flat last month, were down 0.29% month on month. Now, that's weird because if there's one place you'd expect tariffs to show up, the one complaint everybody had about the tariffs on Canada was, oh my God, we get all of our auto parts from Canada. This is going to, cause a major spike in car prices. Guess what? Not only has it not caused a spike in car prices so far, they're going the wrong direction for that thesis. I don't know why. It doesn't make a lot of sense to me, but it is what it is. Now that's in goods, and that's in, again, it makes people kind of scratch their head, what's going on with tariffs. And it turns out that if you take out car prices, then goods prices, actually goods prices year on year for core goods are up 0.3%. Last month it was 0.1% year on year. So they're continuing to move higher as we've expected for some time. But if you take out used cars and new cars, then in fact goods prices are accelerating more than that. Again, not what people necessarily expected out of tariffs, but if you take out, and again, I do not want to fall into the trap, and I always make fun of people who do this. Take out everything that goes down, and what's left goes up, and that's not exactly insightful analysis. So I don't want to fall in that trap, but I do want to. We want to kind of dig deeply enough here to say, are there tariff effects happening? And the answer is yes, there are tariff effects happening, but so far they're pretty small, and this month they were kind of masked by this big decline on the goods side from autos. But there was actually the bigger effect here this month was actually on the services side, and specifically in rents. And primary rents went 0.21% month on month, and that's a lot slower than they've been running. And owner's equivalent rent was also soft compared to what it's been running at. Now, as I said, if we're deporting a lot of illegals, then you'd expect to see rents, primary rents and owner's equivalent rents, you'd expect to see them decelerate, but not that fast. I mean, you're not going to see a massive decline on a month-on-month inflation basis. That just doesn't make a lot of sense. This looks a lot more like last July when both of those figures were shocked everybody. They were ridiculously low. And then the next month it gave it all back. And it was sort of a weird seasonal adjustment issue that went on. And that looks to me much more likely than that suddenly we're just seeing a step downward in rent inflation. Now, if next month we get another 0.21% or lower on primary rents, then you might have to step back and say, okay, well, hang on a second, maybe there is something bigger happening. But all that 0.21 does is it puts the year-on-year figure right about at our model. So, again, what we've been seeing for a while is really gradual deceleration in rents, but not to a level that is consistent with overall inflation being at 2.5%. You need rents to be quite a bit lower than they are now, rent inflation to be quite a bit lower than they are now. And there's just no sign that that's happening. We'd have to get the numbers we had this month, we'd have to get slightly lower than that and repeat that 12 times to have that be kind of to be in the right zone. And it just seemed very unlikely that we're going to be in that zone. And again, I don't want to fall in the trap of taking out everything that goes down and saying everything that's left goes up. But if you do take a core CPI X shelter, and that is a common way we look at things, that's been decelerating for a while. But this month, core CPI X shelter rose to 1.87% year on year from 1.78% year on year, and that's including the drop that I mentioned earlier from autos. So again, abstracting from these big categories of new and used automobiles and primary and owner's equivalent rent, that's a massive part of CPI that I just took out there. And food and energy, we are seeing an acceleration in other goods. And so anyway, all is not clear when all is not, both in the sense that it's not clear, like we don't understand it, and also it's not all clear, like the all clear signal. In both cases, we don't yet have a nice positive signal that we can move on and not worry about rents. We're going to have to worry about, tariffs. We're going to have to worry about tariffs at some point. It just hasn't happened yet. Anyway, now we did see increases in some places, obviously. One of the places we saw it was in tenants and household insurance, which rose 0.84% last month, and in motor vehicle insurance, which rose 0.68%. Insurance companies have been, in various parts of the country, have been increasing, insurance rates fairly significantly for a couple of different reasons. And I don't know that we're not going to probably get that kind of move every month, but that sort of makes sense. One place we haven't seen an effect yet, but that we will, again, on the upside, but not related to tariffs, is in college tuitions and fees. Just this last week, the University of Minnesota announced that they were going to increase tuitions 7.5%, while cutting educational costs 7.5%. So cutting the cost of education 7.5%, cutting back how much they're providing and charging more for it. And I've already talked about that and written about that a couple of times. If the government is going to give, the federal government and state governments are going to give less money to universities for whatever reason, eliminating the Department of Education or wokeness, whatever it is, if they're going to do that, then you're going to see tuitions go up. Hasn't yet shown up in the data. It won't show up in the data for a while, but that's a positive and upward impact that we're still to see. We also saw this month, so we didn't see that yet though, but we did see this month an increase in pharmaceutical prices. They were up 0.54% month on month. And as I mentioned earlier, that's kind of odd because we have this most favored nation policy that Trump is implementing. that should have the opposite effect. Probably not to the impact that a lot of people think it will have, but it shouldn't have prices going up. And so that's kind of weird. So we have some things declining that are sort of weird that we would expect with tariffs should be going up. And we have some things going up that we would expect should be going down because of the most favored nation policy. Long story short, there's a lot of weird things going on this month. Now, some people are going to say, there was a story in the last week or two about how the Bureau of Labor Statistics has had to cut back the number of people that they send out with clipboards to go take prices down. And that in some cases, that was going to lead to more imputation, more sort of intervention analysis, if you will, by the Bureau of Labor Statistics to guess at some categories where they didn't have enough data. And so everybody said, oh, no, because of government cutbacks, we're not going to be able to trust the CPI. And I'm here to tell you that's not what's happening here today. That is going to increase the size of the error bars, but only a tiny, tiny bit. And unless all of those errors are in the same direction, it's not going to impact the CPI at all. So you shouldn't really spend any time worrying about whether or not there are enough people out there with clipboards taking down prices. The BLS already gets most of their data electronically. So, a lot of the retail data they get in a big download from a major retailer that gives them their entire point of sale data. Obviously, lots of other things like rents. You don't necessarily need people walking around with clipboard to go survey rents. A lot of it with telephone surveys. Anyway, long story short is that this may degrade the quality of the CPI slightly, but the CPI is already one of the best pieces of data that the government puts out. So I'm not too terribly worried about that. And it's not this month's story. The weirdness we saw this month is not because we didn't have enough people taking prices. It's in sort of the realm of the normal variance that we would see in any given month. It just happened that they kind of are in opposite directions from what we expected this month. Play this game in your head. Suppose that instead of having rents decelerate, we'd seen them up. Probably a better example is the cars. And if instead of the car prices declining 0.5%, what if they'd gone up 0.5%? That's still well within the kind of normal variance of that series. But the story would be, oh my God, tariffs are biting. And we couldn't really make that statement very strongly because that's kind of in the normal range of variance. It's only obvious because it's in the opposite direction. Same with pharmaceuticals. If pharmaceutical prices had fallen as much as they rose this month, we would say, oh, most favored nation, it looks like it's taking effect. When we probably couldn't make that statement any more strongly in that direction, it would be in line with the narrative. So what's different this month isn't that we have kind of these things moving around. What's different is that they're moving around in ways that are not consistent with the narrative. And that's not a problem with the data. It's a problem with the narrative. Or actually, more to the point, it's a problem with the importance that we put on the narrative to explain the data. At the end of the day, these are monthly numbers. They jump around. And we shouldn't put too much weight on any one piece of data, any 1 month's worth of data, because they do have error bars. We don't worry a whole lot about the error bars, but they do have error bars. And so, examining our navel about every little, jot and tittle is probably not time well spent. But it does make for an interesting month's worth of data. Now, to look at the overall figure, okay, and assuming that I'm roughly right on where median CPI will come in this month on a month-on-month basis, the last 4 year-on-year median CPIs will have been 3.53, 3.48, 3.46, 3.44. So over 4 months, it's decelerated from 3.53% year-on-year to 3.44% year-on-year. And folks, that's just not a major deceleration. It's going in the direction that we thought it would. It's going in the direction that we'd like, but it's not going very fast. And for a long time, I've said, the high 3s to low 4s is where we'd end up in median. Right now, we're kind of converging on 3.5. It just doesn't look like there's a major push to get median inflation down to the mid 2s, which would be consistent with core inflation around 2. So we need to have shelter either continue to decelerate a lot, or we need to have goods prices go back into deflation. Neither of those things is going to happen in the short run. And the tariff thing is going to impact, I'm fairly confident it's going to impact over the balance of this year. So we're kind of probably at the low end of where we can expect year-on-year figures to be for kind of the balance of this year. So anyway, the story is the same. We're going to be looking for tariffs. And then beyond tariffs, we're thinking about, well, after tariffs, after that step change, where does inflation settle down next year? And so far, the answer is it still looks like 3.5% on median inflation. We haven't seen the tariff effects yet. That's where we are now. Is where I would expect that we would be at the end of that. The Fed doesn't have a good reason to tighten. That's the good news. The bad news is they don't have a real good reason to ease because growth appears to be fine, and it isn't like we're about to slip into deflation. So the right thing to do is for the Fed to sit and wait. It will make the administration very angry, but that is probably the right thing to do in a period of uncertainty. Let's wait until we actually have some certainty about what's actually going on. And that's all for this week. Please like, subscribe, and refer others to this podcast, even though it's been a little bit less frequent recently, a little less regular. You can contact me at inflationguy@enduringinvestments.com. You can subscribe for free to the blog at inflationguy.blog. You can follow me on X at inflation_guy. Visit Enduring Investments if you need help with diagnosing or treating an inflation problem. Look to buy the USDI coin if you want an easy hedge and if you're an accredited investor. And most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.